Let's put this into perspective with Avinash Gorakshakar, Head of Research at Profitmart Securities, who joins us this morning. Good morning, Mr. Gorakshakar. Another not good morning, one would say. It's a CEO of Red. Yesterday was understood as it was, of course, the expiry day. But today, again, markets are opening absolutely on a pessimistic note. Brent oil has touched the $100 mark in early trade this morning. So what are you making of the story right now?
Yeah, I think good morning, Kartik. My sense is markets will be volatile now going forward because clearly the oil shock is yet to uncover. I think government has made a very conscious call that they will be looking at Russia. But I think if you look at the broad fabric of the market, I think everybody is now looking only at the geopolitical situation. And in these kind of times, the markets don't look at fundamental; they look at what news happens on a minute-to-minute basis. So I think today will be another volatile day. My sense is 23,500 on the Nifty is very important. If we do not sustain that level, then I think you could see further selling pressure. So I think we'll have to wait and watch how the market actually takes off in the second half. The first half is not expected to show any major upside at all.
Major upside. What are the biggest fears? We understand that the conflict in West Asia broadly is what is defining sentiment in the markets. But is the biggest fear coming from rising oil prices? Because Iran has warned that oil prices could reach as high as $200 a barrel. That would be the highest in the history of, of crude oil prices. But we've seen them touch $120 a barrel, come down to back to about 90 odd levels. And this morning, again, $100 a barrel. Is oil and inflation, which will eventually be passed on, imported into India and passed on to consumers, the biggest sentiment dampener right now?
Yeah, I think oil prices continue to be the main fear factor. In fact, see, crude has got a direct impact on inflation. If inflation increases, that is going to make obviously markets a little worried. And most importantly, the oil sensitive stocks, specifically oil marketing companies, paint companies, tire companies, carbon black companies. Typically, these are the companies which are going to be hit. If things don't improve in the April to June quarter. I think up till March, if this war ends, I think things should be sorted out, but if this war extends beyond April, May, June, then I think, as you mentioned rightly, the rupee is also going to face increasing pressure. We have been seeing a lot of FII outflows. So that also is going to put a lot of pressure on the rupee. And these two factors combined are the biggest factors, the rupee and the oil price. I think this is something the markets are a little worried about.
And both absolutely critical components of India's current account, which is the deficit is likely to balloon again with rising prices and depreciating rupee. Remember, rupee has depreciated below that $92 mark yet again. Meanwhile, I'm looking at some of the sectors that you mentioned, Avinash. I'm looking at oil marketing companies and absolute bloodbath there. You're seeing stocks of Hindustan Petroleum down more than 3%, 3.3% or so in trade. Indian Oil Corporation, which runs the Indian brand of LPG cylinders in addition to petrol pumps, of course, as well as BPCL, both down about 2% or so in trade this morning. Where does the story go from here? Because we understand oil prices are going to be choppy, they are going to be volatile, and if anything, they will only remain in the higher territory for longer. But the government has said that the retail price of petrol and diesel is not going to be increased, squeezing margins of oil marketing companies. How do investors read, their participation in these stocks?
No, I think you're absolutely right, Kartik, that prices will not be increased, but somebody will have to bear the burden of increased cost, and that is where oil marketing companies may take a hit on their margins. The April to June quarter is going to be very crucial because up till March there's a little bit of inventory with all these companies, so I don't think you're going to see the impact in the Jan to March quarter. But I think LNG and LPG, also which are imported. I think LNG Qatar has already said that supplies are not going to be now as per assurance earlier. LPG, almost 60% of LPG is imported by India. So, these are two also factors which are going to drive the profitability on the lower side for oil marketing companies. So, I think till that time, it's going to be negative. I think markets are going to wait for some clarity to emerge. If we don't get clarity in the next, say, 3 to 4 months, we are keeping our fingers crossed that March end, this war should end. But if it doesn't, then I think you're going to see lower margins in the April to June quarter for all these companies.
All right, lower margins in the April to June quarter coming already on the back of lower returns for investors. I want to pull up that data because ever since the war started, 27th, 28th of February, midnight for India, Nifty 50 has given a negative return of 5.2%. Compare this to the sectoral negative returns. The Nifty oil and gas is down about 6.4%. Nifty auto is down almost 8%. Nifty bank is down almost 8%. And surprisingly, Nifty IT is relatively a little better off, down still, but down just 3.1%. Investor wealth erosion, some estimates suggesting as much as about 35 lakh crore rupees of investor wealth has been wiped out. Avinash, what should retail investors do at this moment? Because many of them would not have that liberty to sort of sit on cash at the moment, because they would have parked their investments in equities. How do they cash out if they want to sit on cash? And if not, what should they do right now? Because they may not have the liquidity to buy good companies at a cheaper valuation.
No, I think, Kartik, the focus for the investors as of now that they should focus on domestic themes, domestic sector, because that is one area where I think, you get a little bit of comfort, where the crude, headwind is not going to impact them. So typically, sectors like auto, sectors like hospitality, sectors like hospitals, sectors like capital goods, I think definitely these are more productive sectors. In fact, cement could also be added. And I think despite the fall in the banking stocks, see, our sense is that credit growth is close to double digits. The government is also going to, sustain the capex, which was mentioned in the budget. Private capex is increasing. So I think banks also could be added because good quality PSU banks have been beaten down, something like a Bank of Baroda, a Canara Bank, a Bank of Maharashtra. So, these are opportunities where some amount of money should be deployed. And even when you deploy capital, my suggestion is that don't put all your money in one shot, adopt a small SIP approach and gradually release capital, because we really don't know how far the market will go down, and you require a little bit of cash and ammunition when the market goes down. So this strategy will definitely help you. I think when the market settle down and things get clear, I think the bounce back also will be very fast in these sectors.
Well, hopefully that bounce back should come strong and hard and quickly at that. But meanwhile, talk to us about the larger implication, because, there's going to be a limit until when the government also holds off on passing on that, that inflationary oil prices back to customers, and potentially election season not doing government decision making any good at the moment. But looking at oil prices, looking at the trajectory of oil prices, and, you have it plotted there on the screen, going all the way up from about $72 a barrel a day before the start of the war to about $100 plus today, right now as we speak. In fact, it's at 100.45. But overall, there's going to be a point after which the government will have to pass on this cost to consumers. And passing that on means there's going to be inflation and there's going to be a slowdown in economic growth. Overall, what does this mean for India? What does this mean for India in the coming financial year? And of course, our growth aspirations.
No, exactly. I think, see, as of now, I think things are under control. But I think once crude touches $120 and plus above, I think at that point of time, it's going to pinch, the government also very badly. And at that point of time, maybe the government will have to forcibly, take a decision that oil marketing companies will have to raise prices, because beyond a point, it is not economically sustainable. So I think, we'll have to wait for a couple of weeks how the situation, on the ground, takes shape. But I think $120 and above is going to be a trigger point. So I think we'll wait and watch. But yes, I think this is definitely going to be not easily going to be solved in the short term. So I think next 2 to 3 weeks are very crucial.
2 to 3 weeks are crucial. Meanwhile, some sectoral input from you, Avinash. I'm looking at auto stocks. And again, yesterday we saw the auto sector and the BFSI sector both take a massive beating. This day, starting off this trading day again, we are seeing auto stocks absolutely bleeding in the red. You were saying that potentially this would be the time to look at some quality stocks. Do you see any buying opportunities for retail investors who may be sitting on some cash at the moment?
So I think, see, if you look at the third quarter number before the war started, I think companies like Mahindra and Mahindra, Ashok Leyland, or for that reason, two-wheeler companies like Hero Motor, I think volume growth has been very solid. The GST cuts, the interest rate cuts, and the rural demand has shaped up very well for these companies. And typically, January to March is anyway a bumper quarter for the auto companies. But our sense is that auto companies are unlikely to be impacted very badly. In fact, within the two-wheeler space, companies which possibly make the electric two-wheelers, they should benefit in the short term because a lot of alternatives are being looked upon by customers. So I think, broadly, it's not going to be a very negative surprise for these companies because they do acknowledge the fact that if oil prices go up, then the operating cost to maintain these vehicles will be higher. But that doesn't mean that vehicles will not be sold. So I think auto is a fairly comfortable space. If you get these stocks at lower valuation, I think you should try to at least park in some money because the bounce back here will be equally sharp. I think we don't know how long the war will continue, but once it gets over, the bounce back also will be equally sharper.
Right, bounce back will be sharp for the auto sector. Look at quality auto stocks. I also want to touch upon the BFSI sector. Again, a major sort of, impact coming with the withdrawal of capital of FIIs, the flight of capital. How do you see the BFSI sector? Is that likely to be a little more strained for a little longer?
Yeah, I think in the short term, there will be definitely some hit on the BFSI sector. And, frankly, the BFSI sector is something where, in the short term, it's very difficult to visualize what will be the impact of the cutback and the large selling FI pressure. But I think, as I mentioned to you earlier, the banks and the NBFCs, I think are two pockets where I think one needs to stay invested. Bank Nifty is very volatile because there's a presence of almost 25-30% in the Nifty by the banking segment. So that is the reason the markets have actually seen a big beating in the PSU banks. But otherwise, I think small exposure in the banks and the NBFC is advisable. I think it may underperform for the next 2-3 months. But once things clear, I think banks and NBFCs could definitely also be good assets for an investor, going forward.
So banks and NBFCs might be good assets. Finally, I just want to look at the market data once again. Sensex and Nifty continue to bleed this morning. I also want to compare that with what we are seeing in Asian markets because remember, there's been a little bit of recovery from that absolutely low start. In fact, Sensex has gone back above that 76,000 mark. But if you compare India's fall today to other Asian peers, including Japan's Nikkei 225 as well as South Korea's Kospi, India again seems to be relatively better off. So what we are seeing, Avinash, as a trend is that on days of market crash, India's crash is a little more contained than the crash that we see in let's say, Japan and South Korea. And even on the days of recovery, on the days of rise, India's rise is a little slower than the rise that we are seeing in Japan and South Korea. How do you explain that sort of disparity?
No, I think on the macroeconomy side, we have been managing our finances very well. And, before the oil shock, we were one of the economies where the GDP growth, where the current account deficit was managed very well. So I think, this is one factor which is going in favor of India. Within the Asia Pac, I think, if you look at the smaller countries like Bangladesh or Sri Lanka, in fact, we are far better than them. In fact, countries like Bangladesh and Sri Lanka, including Pakistan, they are definitely economically very weak, and any increase in the crude oil price is actually going to upset their financial metrics very badly on the macro side. So I think to a large extent, in relative terms, we are far better off. But I think we'll also have to keep a continuous watch on the oil price because this is one component where India still imports a large percentage of the crude oil in the country. So net, yes, we are far better off, and that's the reason you're seeing relatively lesser kind of a weak kind of performance vis-a-vis the entire Asian pack as of now.
All right, Avinash, let's leave it at that. Thank you so much for all your input and for joining us here and giving us your time. As always, pleasure having you with us on News9.